Hello, good evening, everyone, and thanks for coming for tonight's webinar, our very special OTCS Special Market Outlook 2021. A very warm welcome to you, and my name is Richard. I'm the host for tonight, and I'm also part of the OTCS committee. Just please allow me a few minutes to share with you more about our club. But before that, would you please also join the Telegram channels of these good people who have brought you tonight's webinar and market outlook? They are Online Traders Club, Wealth and Joy, Retirement. Okay, so these are the Telegram channels that you can join to be kept posted of upcoming webinars as well as market insights. And also, I would like to recognize Wealth Lions, You Savvy, and IG Singapore for helping out in making tonight's market outlook possible. So without further ado, let me now give a quick intro about OTCS. Now, OTCS stands for Online Traders Club Singapore, and we are a non-profit society formed in 2005, and we are a community of traders and investors here in Singapore. And to me, OTCS stands for a place where we network, share, and learn, and we do it through a series of workshops, courses, and our library. And for workshops and webinars, we aim to hold about 10 to 12 a year. It is normally free for our members and paying for public. But since the COVID days, we have made everything online and make everything free for everyone. Okay, so enjoy. And this is a photo taken from our 2020 Market Outlook. Traditionally, we held it in SGX Auditorium, and they are one of our sponsors, and it was very well attended. But since COVID, well, we can't do it there anymore, so we do it online now. For courses, we aim to have about 3 to 6 a year, and we normally will do a group buy with suitable trainers to get a better deal for our members. And for our library, we have over $6,000 worth of resources. And if you'd like to find out what they are, you can go to onlinetradersclub.org to check out the PDF there. But because of COVID, well, I think we won't be making the items available until post-COVID. Then the next question is, how much is the membership? Well, the normal membership fee for Online Traders Club Singapore is 120 Sing dollars a year. But for a time-limited period only, it is $60 a year. And back in the day when we meet physically, pre-COVID, we also provide dinner. So if you come for 10 to 12 workshops that we hold physically and eat the 10 to 12 meals, dinner, then you basically, the membership is basically free, or you have paid for your own dinner. So to find out more about how to join Online Traders Club, please go to our website to learn more. Currently, we do not have plans to charge this membership fee, so until further notice, and we are doing everything online, so enjoy the contents that we are sharing online. And if you'd like to be kept posted about our club's activities, please join our Telegram channel and search for Online Traders Club in the Telegram app and join that channel. Or if you prefer the traditional way of joining an email mailing list, please do so at our website. And Online Traders Club is not just run by the committee. When we had our physical workshops, we are also supported by a group of friends who help us out in making sure everything runs efficiently and smoothly during the physical events. And they are our OTCS crew, and I'll just like to give them a shout out and to thank them for helping us out. And very importantly, the disclaimer: you are responsible for your own profits and losses. The speaker's opinions are their own and does not represent OTCS opinion. OTCS is office holders, associates, and sponsors are not responsible nor liable for your losses. OTCS events are for educational purposes and should not be construed as advice. And when in doubt, please seek professional help. All right, now for those of you who have just joined us, please, if you'd like to be kept posted of more market insights and webinars, upcoming ones, please join the following Telegram channels: Online Traders Club, Wealth and Joy, and Retirement. And if you'd like to check out what Ian is doing, please check out wealthlions.com. And also, we'd like to acknowledge our media partners, YouSavvy, and also our invited speaker today from IG Singapore. And today, we are bringing you a panel of 3 experts who are very competent in their respective domains to share with us their insights and opinion about where they think that 2021 is going to take us. Now, 2020 has been an unprecedented year in possibly human history, at least as long as I had lived, right? So the economy is not doing well. The COVID has turned so many things upside down, and it doesn't seem like it's abating throughout the world. But yet, the stock market for certain markets are going, up and up and up. So some people call it a K-shaped recovery. So I'm not the expert, but the speakers tonight are the experts. And without further ado, I'd like to pass the mic over to our first speaker from IG Singapore, and she is none other than Miss Pan Jingy. So Miss Pan, would you like to take over the stage?
Yeah, Richard, can you hear me? I just want to double check this.
Yes, hear you and see you.
Okay, great. Right, everyone, I'll just start sharing my screen first, so just give me a quick moment here. Now, okay, Richard, let me know if you can see my screen. But everyone, just want to say Happy New Year to you. It's quite funny because I was like telling this as well to, I know it's really like 26th of January, and we're still saying Happy New Year, and I was like telling that to some of my Angmo colleagues in the UK, and they were like, are you still saying Happy New Year now on the like 10th day? And I was like, yeah, we don't stop in Singapore until after Chinese New Year. So yeah. So Richard, is everything all right with the screen?
I haven't seen your screen yet. Did it
Oh.
permission?
Yeah, I think it's just a lag that we have here.
We'll give you a little bit more time. Yes, okay, it's out.
Okay, wonderful. Thank you. Okay, I shall begin now. Right, so everyone, good evening, and of course, thanks to the OTCS folks for actually inviting me to chat with you on the market outlook for 2021. So I guess for market outlook, the theme that I've already selected today is the road to recovery continues. I remember the last large webinar with IG. We don't conduct maybe a lot of this once or twice a year. Some of the big ones from by our head of education, Terence Tan. Some of you might have heard from him. I think he just came off one webinar as well, if you have been with us as well. So he's a TA specialist, CMT certified. Certainly coordinated that one in October for us, right before the US election. Well, that was seen in November, of course. So at that point of time, I think I've been emphasizing that the worst is over, and that with the pandemic hit in the April period. But fast forward to now, a lot has happened. You have the vaccine development, Pfizer BioNTech, Moderna vaccines using the mRNA technology. This proved to have high efficacy. I think if you get offered, do really consider taking them as well. The kind of blue sweep for the US election being taken in a positive manner, and of course in the immediate term, really seeing to this kind of expected fiscal support. That is the latest positive item I think we've really been seeing. So a lot of good things has been happening, and I'll say that the market has been pricing a lot of which in. So that brought me to this question as to really considering where next, and this is why I chosen this topic. So that was in October, it's called the road to recovery. Added the continue word here so I think that's really capturing the kind of gist that we are seeing. Just before I begin, as usual, probably used to this, please allow me to read out the disclaimers by IG. So specifically the key points below. The information prepared by us is intended for general circulation. It does not take into account the specific investment objectives, financial situation, or particular needs of any particular person. And you should take into account your investment objectives, financial situation, and needs before making a commitment to trade. Now, with that over, short introduction of myself. I know Richard already did so, but I've been with IG for the past 4+ years, covering markets mostly traded by clients locally in a lot of spanning the FX indices and also selected commodities, prior to which I used to work as an economist, focusing primarily on FX analysis with research and forecast, which is now rebranded as Continuum Economics. Started out of a government agency looking at manufacturing investments in Singapore. And my background is both in economics and also applied finance. Well, you might see me hanging out sometimes on TV tomorrow as well on Bloomberg in the morning if you want to catch that. Been also on Money FM this morning since 6 o'clock. So I should make sense, but if I don't, yes, yeah, you should know. But I will, don't worry. So rest assured on that. Okay, so organizing the content in what I would say is quite a bit of a short session today. I understand from Richard as well that you can throw out your questions anytime as well. So do feel free to do that. But for the time that I have chatting with everyone, to really get a bit of an outlook into 2021, this is how I'm actually arranging it. So we'll start with market assessment, and then going on to look at where are some of the opportunities and touching on the trends that one can trade. So hold on to the end as well, because I have a link for you to this free IG ebook on trading trends, which we have put together with Bloomberg Media. Okay. So now, really in terms of the market assessment, I think it's really an interesting one. Sorry, I do think there. Yep. So now on the market assessment, now I think evidently, Richard has started us off on this as well. But one of the most devastating and perhaps important driver for global markets over the last 12-month period have been none other than the COVID-19 pandemic. And we are still very much in which, even though perhaps we're not feeling that so much strongly in Singapore. Globally, you can see that the third wave is being the case right now. If you observe the waves that I have, circled here with the red line, we've initially in March seen the first round of outbreak globally, and then that released into the circuit breaker we had in Singapore, and then thereafter in the summer months in the US, Europe, it had worsened again in July to August, and certainly I think right now into January 2021, we've really again actually seen this really rising. The daily cases is sort of like kind of peaking at this point of time, but there's been new restrictions seen leading to this being the case. So hopefully, we are going to see this being the peak with the vaccination going around, and that things will not worsen again, especially after Chinese New Year period. But that's the picture that you have. And here's another chart showing how the situation is like globally. So and individually, on the right here with the European countries and US as well, things have gotten quite, I would say, a lot worse in the past couple of months. And this kind of risk of resurgence, well, it's not something that we rule out, but that being said, I think the outlook itself, we'll touch on it later, is still broadly one that's we're seeing a little bit more positive. And touching on the global GDP, I think, consequently with a lot of the lockdowns and border restrictions, Q1, Q2, that's been bad. But that being said, recovery has taken place. So the interesting chart that I want to bring your attention to is the chart on the right here. So this is a picture showing how some of the biggest economies, US, Europe, UK, Japan, had all seen the worst being left behind in 2020. But in terms of whether growth had recovered to levels prior to the pandemic, the answer is no, it's not yet. Although China, the one in red here, if you look at it, did actually see into end 2020, they've picked up from where they left off before the pandemic. First in, first out, quite a common term that I'm sure you're familiar with. Monetary policy, evidently super supportive, this in terms of interest rates and asset purchases as well. Major central banks really feverishly expanding their balance sheet into 2020. So now, that comes the question as to where exactly are we on in terms of the economic recovery. And I think that's also been the kind of interesting picture. So the chart on the left here evidently reflects the manufacturing sector PMI that had been on the rise. Now, PMIs are month-on-month readings. So a reading above 50, which is the midline over here, signalizes that things are actually expanding. But, that doesn't mean that the picture suggests that things are back to where they were before. If you remember the GDP, well, against the index of 100, that would be more indicative. And I like to look at the chart on the right over here. So this is the Citigroup's economic surprise index. So well, I look pretty much at this as a reflection of how the economic data is performing relative to the market expectation. And you can see that the US as a developed country representative actually continued to surprise, so it's on the upside, but the degree at which it's doing so has slipped into end 2020. On the other hand, however, the blue line over here that represents emerging markets in terms of how the economic data is faring against the economists' expectation. That had actually started to see more surprise, and I think that's a good sign as well. It's really in line with our conviction as well that we're going to see more emerging markets doing well. So look at the emerging index, so on and so forth. Last November, we had a webinar organized by Bloomberg with myself and chatting, and Mark Mobius as well, just really talking about it. And you can watch that replay online as well. So most of you will have had a picture of how your trading performance or investment had done in 2020. Hopefully on the positive side, but if you don't get a very clear picture, I think this year might help. So it's a broad snapshot that I've collated. Obviously, Bitcoin came in to be very popular, but if we look a bit wider to the broad market, it has been a case of technology growth companies doing better compared to the likes of value stocks, and the likes of US market doing a lot better than the rest of the world, including our Singapore market over here. Recovery has also been rather uneven across the world and across the sectors, especially if you look at the likes of the US S&P 500 index and the Dow. They have been the ones to perform really well. But the likes of the local Straits Times Index, or even if you look at the UK market, they have fallen behind. And if you will translate this into how the sectors are doing, also it's another interesting trend. And I think we are all cognizant. We all know this. Those with high technology constituents, they do a lot better because the technology sectors have been the one driving things. And I think one of the questions you will have is whether this is going to continue, which I'll address later. But over and above that, you do see the likes of financial companies. They are the ones lagging behind. They did try to make a bit of an attempt to catch up since November, but they are certainly still lagging behind in terms of this recovery, which is why I think it's quite important to focus on this point. So where are we now in the road to recovery? I've shown this towards the end of last year. I think it's still very much applicable at this point of time. My title has given it away for this webinar today. So the fact that it continues, so I want to explain what exactly does it mean. So this is a widely noted chart between the market cycle, which is in blue, and the market, I should say the financial market cycle, which is in red, and then you have the economic cycle, which is in blue, which shows how a typical sector rotation would actually look like. Now, notice that I use the word typical here because it's not a typical kind of market cycle that we have experienced for when we're dealing with a public health crisis. So the defensive sectors that you are seeing, in the early part of, how things are doing, they will not perhaps look too much like your usual defenses, but instead it's like technology, healthcare, staples during the COVID-19 era. So do take the green boxes with a pinch of salt, but just note the kind of difference between how the market and how the economy recovery looks like. So I usually like to look at this, and I do quite a bit of a report on this every Tuesday as well if you subscribe to our momentum report on IG. But using the S&P 500 index as an example, you can see that things have fallen about 24% from peak to trough in March Q1 2020. But thereafter, prices had surged about 72% to, I did this over the weekend. So as of last Friday, I think things have been, about more than 70% increase in terms of the S&P 500 index, just price alone from the lowest point. So we are certainly in a bull market, but, this is looking at the financial market. But in terms of economic conditions, I think that's where the question is also, to locate where we are on just on the table I've shown you. So economic conditions is still on the mend, as shown in the earlier pictures. The global GDP besides China is still well away from pre-pandemic levels. You do find a large V shape over here for the global GDP recovery on the left, but take into mind that the drop itself had happened during a time when you're having drastic lockdown situations across the world. In here, we felt it as well in Singapore. But thereafter things did pick up, and that's with the lockdown situation suddenly easing. That saw to a quick rebound. But from where we are, we are going to be. I think the recovery from here is still expected to continue, but perhaps at a bit of a slower pace. So to that extent itself, yes, a slow recovery, but recovery nonetheless that I'm looking at. And to the right over here, just talking a bit more about economic data, bear with me, so that the unemployment rate across the world, and I just want to put this on the chart. Now, if you look at China, there isn't a lot of data that they have, but enough for us to compare at least to say 2018 levels. So China, yes, the unemployment rate is certainly declining. So the lower the better, right, unemployment rate. But in comparison, if you look at the rest of which US in orange over here, they are seeing a sharp decline from the 14.8%. So think about it, it's like 1 in 10 people in the US in April, dropping at this point of time, it's doing a lot better, but the expectation, especially with a bit of resurgence in terms of the COVID-19 cases, is that it's not going to come down so quickly the way that we are certainly seeing things to be. So that in one, and if you look closely as well to the likes of Japan, to the likes of UK, in fact, they are actually still rising. So that's the picture that you have, economic conditions still on the mend. So with that, I would judge that we are still where we were, perhaps, before the vaccine development really came about. And that's, Q2 have widely been seen as the worst of the recession been over. We are in recovery, not fully recovered or growing on a global scale yet. I think this, if we look at the IMF growth outlooks, I'll be interested to see how that one. Remember, don't just look at the headline number, look at the number excluding China, because China is obviously the first in, first out, and they're doing a lot better. So we could be near the market top. And that, I think, a lot of people have been asking, are we in a bubble? Have we seen the top yet for the market? Just to give you a bit of a sense, now I think, it's going to be like looking at the crystal ball in order to really tell if we are on the market top yet, but just give you a sense, where we are. So a lot of question has been asked as to whether the bull market had outrun itself and whether it's overdue for a reversal. At this point of time, my take is no, and that's my personal take on this. I think, in the short term, definitely, there's going to be a lot of earnings this week. We have, I think, 25% or almost 25% of the S&P 500 index reporting earnings, and you have the bunch of some of the FANG stocks, Tesla, Apple, and I think what's the last one, Facebook, all actually reporting Thursday morning here for Singapore. We are going to see if they measure up to the expectations, but that could make for a bit of short-term volatility. But I think, broadly, I think the fluctuation with the earnings season in the short term is expected, but I think, there is still room on the upside. I'll go on to explain a little bit more why that, it's my take, but just using, historical data here to analyze it. So historically, since the late 1950s, you can see that on average, the bull market gain have been in the zone of about 158%. So that's the average. If you remember the chart earlier I showed you on the S&P 500 index, that had risen by about approximately 72% from the lowest point. So it's still below average. So I do think that as the recovery continues, there is still market opportunities. But of course, I'll also highlight to you the risk. So with that, we're going to move on to the slightly next segment of, what does this translate to in terms of market opportunities? So classifying risk. I like to look at, let's take a sip of water. So classifying risk. Now, I like to look at this in terms of 3 categories over here. So whether it's in terms of trading or investment, you want to look for trends and themes. I think that's the way that I really conduct, how I look into the market. And I do think that a lot of these trends, as we have seen through 2020, can be very powerful, especially when you have both the fundamental and technical working hand in hand. So I do sort this in a bit of a 3 different boxes. So on the left side here, it's the known knowns. Now, these are the things that most of us are aware of and know, and the market sees it as well. So a lot of which, yes, it may have been priced in, but I continue to see these as the themes that will carry us from here. Then if it does changes, then it will be something that you kind of like classify there as well, and therefore you have to trade according that if the trend changes. So yeah. So then the next thing is really the kind of like known unknowns. So they are like things like geopolitical risk. Yellen had stepped up and talked about China with unfair practices. Yes, we could be seeing, and I would say Davos as well. You had heard from President Xi, just really talking about non-confrontation. But then Biden's, I think their White House spokesperson, Jen Psaki, I think really went on to say that it doesn't change things. So geopolitical risk, I think, still could be on the horizon, but we simply don't have enough information to actually predict these items. So that's the kind of known unknowns, but we have to take into account and just be aware if that really comes up to become a thing. And then the last but not least will be the unknown, so which is what we have seen in 2020, the COVID-19, this kind of black swan events. So I think on that end itself, yeah, you can't predict, you don't know what you don't know, right? So it's, I think that to a large extent, not something that is useful. So we will actually, focus a little bit more on, the first unknown, the known knowns. Now, if you perhaps had listened to the one in October that I thought by any chance, don't worry if you didn't, doesn't matter. There's a bit of a change. Evidently, the risk of central bank tapering had come up. I wanted to list this to just really, as I said, when you see some potential risk, to highlight it. But at this point of time, I don't think it's going to be something too substantial. But I just want to, talk a little bit about it towards the end as well. So on the back of the first one, now let me just go back a slide here and just talk a little bit more about the 3 things. So first and foremost, we have digital acceleration. That I think, is seen as a huge trend, particularly over what's happening in COVID-19. You and I, we are talking here through this virtual form rather than, being physically in front of you guys, as what I've seen Richard's photos look like, and that looks really lovely. But that's digital acceleration, and pretty much I think that's the trend going forward. And then there is also the recovery with accommodative policies. Now, what I'm trying to emphasize is a bit on the fact that we still have a lot of policies that's real supportive for growth, but I just want to, move in a little bit details later on as well to be a bit more selective into how we look at the recovery from the next leg on from here. And then just now the risk of central bank. So first and foremost, digital acceleration. I think that's the interesting one, because we have seen US Fan really charging ahead, and so the NYSE Fan Plus Index, I should say by its official name, it's been continuing on this bullish uptrend. Prices have been way above where things were before COVID-19, but that I would say it's not a surprise as well. For these big tech stocks having become, beneficiaries of the COVID-19 pandemic hit. Just take Netflix, for example, last week, it's been one truly, oscillating to the lockdown situation. In Q3, subscriber numbers was a little bit disappointing, but the latest Q4 number just, I think, jumped through the roof. And that, of course, unfortunately, have been due to the fact that we have renewed movement restriction orders around the world that has, seen to that jump in numbers. But with the likes of Netflix, though, that kind of performance had really helped push them to, for them to move into being free cash flow positive and considering buybacks, which is, in such conditions, a big deal for them. And I think, that being said, how are the market actually viewing the FANGs? That is a question. And these are based on the equities analyst view over here. So these are the guys who did really, really deep into all the balance sheet, income statement, and all that stuff. And you can see that the 12-month target price, which is this category here. So the price, this is, I updated this morning. So yesterday's close would be the closing price that you find over here. So you can see that actually the consensus target price shot for Baidu, Tesla, and just very recently Apple as well. The rest of which the market actually is still holding quite a bit of a bullish view as well. I think certainly for the ones like Alphabet, Amazon. These are the ones that the market's looking quite closely to the earnings coming through. So at this point, I'm not suggesting, this is the best time, you need to get into the NYSE FANG Class Index, or if you're trading with IG, it's called the US FANG Index. But if you have been in this trend, I think neither is it time to get off the bus yet. Time and time again, you have seen, the market trying to test the uptrend support that I've actually drawn here, and it's still holding rather nicely. In fact, prices had actually leaped forth and opened up further upsides last week. I think there is a sense that valuations are certainly lofty. If you look at the price to earnings ratio, it's way above historical average. But the expectation here is that, that to one extent reflects the kind of low interest rate environment, but also there is a sense that the expectation not only for the earnings, which is the denominator, to play catch up. However, of course, if any, bad news does come by in terms of earnings, that could see to a bit of a volatility for this trend. So, which is why, whenever we look at, we try to, personally, I look a lot into trends. So I do really advocate as well to really put in this kind of risk management measures, and whether this is in terms of your stops and guarantee stops that we have. But I think broadly the fact is also that economic recovery continue to be underway, and that with some of these guys, the FANG stocks that the market's potentially looking at Q4 really getting a bit of the boost. Now, one of the stats I think that I feel like I need to really highlight as well is that as far as the earnings season is concerned, and really touching on this for the short term, whoever that's really trading the market at this point of time, the 13% of the companies that have reported earnings on the S&P 500 index has seen 75% surprising in sales and a strong 86% in terms of earnings so far. So it could be the case that the market had been really a bit too conservative on the earnings estimate, and surprises here could still continue to drive the FANG stocks outwards, with particularly a lot of this unfortunate Q4 movement restriction orders to boost this performance. So keep a lookout on this. I think definitely one that if you're in the market right now, this is there is still potential, at least in the short term, to see for the upsides. But that being said, I want to look a little bit towards the medium term as well, particularly just serving maybe everyone who's like perhaps looking at different time frames. But what we have here also, when it comes to the outlook webinar, I think it's really the question of where next for markets, the opportunities. So I think it's an opportune moment to bring out these guys once again. As I mentioned, recovery have been uneven across the world and also across the sectors. And this is why the ones playing catch up will really, in my opinion, be the ones to capture the next leg of returns. I had emphasized this in October, just before the vaccine development jump started this catching up of the laggards. And I want to emphasize this once more into the first half of 2021. So, as the market go on to the next leg of recovery, a lot of this talk have been on reflation trade. And even though, it had really been strong into end 2020 and some early parts of 2021, I think there's still further room to go, particularly this being the case for value stocks that had, really lagged the growth stocks in this extent. So the uptrend here, I think, with the value stocks, really the ones that are sensitive to economic growth, they are the ones, in my opinion, that has the potential to continue. Once again, and there's also been talks on valuation for these guys, but earnings, I think, from what we have seen with the tech, I think that's picked up strongly. But I think the acceleration in earnings recovery for many of the value stocks, the ones, as I said, it's been sensitive to economic growth, could just pick up pace as the vaccine gets around. And I think that through 2021 is going to continue being the case. It may actually see a bit of a mix in terms of how the vaccine distribution is going to be in terms of the speed. But I think, that's the direction we are no doubt moving in. So I think that's a bigger picture. So yes, just to highlight as well, a lot of what we have seen with the value stocks right now is also financial stocks. So on that end itself, just to note, for financial stocks there, even though there could actually be this kind of yield curve, steepening situation, yield rising. You hear a lot of that, particularly when people talk about just really the reflation trade. That's also likely to benefit these financial stocks. So I think that's the picture that I want to present. And I just want to show this as well, because I talk quite a bit about value stocks, what exactly you can look for this. So this is one guy that, that's capture it, and that's the S&P 500 value ETF, which we have here on IG. So you can see that while the growth stocks, well, the IT stocks had really pushed past pre-pandemic levels, this guy is, well, you're seeing a bit of a Dow theory. I can, really been addressed to this extent itself. So it's still trying to push past the earlier resistance level. And I think, that could really, that break past is going to extend that kind of uptrend for this itself. Okay. Now, in addition to that, I think, country-wise, it is also pretty much the situation, particularly if you look at some of the popular trader indices for IG, which I know I've highlighted here. So the likes of Singapore and UK market had actually been lagging their counterparts around the world. The Hong Kong market, now we seen that one was quite interesting. So that guy had done quite some catching up. But with the Singapore and the UK market, I think, there looks to be opportunities. With the UK market, I just highlight because I have the Singapore index on the next slide. But the UK market, I think, had been one really pricing in a lot of what's happened with the Brexit, for example, and also just really in terms of the COVID-19 situation. We know they are having their third lockdown at this point of time. My colleagues in the UK, I think definitely they are suffering and hoping, this is going to improve from here. But I think, that being said, they are also really ahead in terms of vaccine distribution, and we did eventually get a Brexit deal. Now, there's still a lot of things to iron on that end itself, but the fact that we did not have a no deal situation, I think, lightens things up for the UK market. So they also, I think, along the Singapore market, has this potential to play catch up next. So I just really want, to keep that in mind, because, as we talk about, it's about combining a lot of the fundamentals with the trend as they get kick-started. So, that keep that in mind. But coming back to the Singapore market now, the local Straits Times index have been one that's, really, I would say, they were flirted with the 3,000 level, waiting to extend that kind of uptrend. Yes, prices did slip a little bit, and that's really, I think, on a little bit of the COVID-19 concerns once again. But, my view with regards to where is the Singapore index, in this case, really the Straits Times index, which is a related index here. What we are seeing is that it could really be treading water for a little bit, waiting for, the next stage of recovery, particularly as the vaccines get around, and that could see to further reopening. I think hopefully a lot of people on the other end here really is hoping for that bubble to reform again. I know it's going to be hard, I think, for some time still, but that, it's the next anticipated point, I think, that we're looking for. So with that being said, the Singapore index, in our opinion, towards the year end at least, is expected to go back to pre-pandemic levels. But for the short term, I think, it could really tread water a little bit as the kind of volatility be seen in the US market in particular. So yeah. Now, I think this is a very pertinent discussion. I think I've been getting asked this a lot, so I thought it would be a good time to really share this with everyone as well. Particularly, there's a question on whether Fed tapering is going to come about. It's going to be a risk for the market. Now, we know that the Federal Reserve themselves have been keeping interest rates low. 0 to 0.25% is where we have been seeing things. But over and above that, there's also that 20 billion in terms of their asset purchases itself. So the question that's been really asked is whether they could start to taper, particularly during a time when the financial market is, feeling all the rage, and, people are like talking about the GameStop and that kind of things, where it doesn't really make a lot of sense from a fundamental perspective, but that you have a lot of the lofty, I think, as China, they would say, it's a bit of this kind of like furor that's been seen in the market as well. So why would this be important? I think one just needs to remember the kind of taper tantrum we seen in the 2013-14 period, where the consideration of the Fed lift off had really spooked the markets. So question now is, are we coming to the situation where the global economy recover from the COVID-19 pandemic that could see to enough Fed tapering? I would have to judge that it is not exactly expected yet. So if you look at the periods, box in the red dotted line. So I just want to explain this chart a little bit. So the white lines over here are the US 10-year break-evens. They are your inflation expectations in accordance to the market. The blue line is the US unemployment rate. So two things that I can say that the Fed look at very closely. So the lower the unemployment rate, the better. And then you have the yellow line, which is the Fed fund target rate. I use the lower bound here to make it a little bit clearer because people like to talk about 0%. So you look to where exactly things have been lifted off. So I highlighted in the red boxes, in the first two boxes over here, you can see this is when the Federal Reserve had actually lifted things off. Now we understand, just want to quote a little bit of their latest statement seen in December 2020. So the committee decided to keep the target range for the federal fund rate at about 0 to 0.25% and expected to be appropriate to maintain this target rate until labor market conditions have reached levels consistent with the committee's assessment of maximum employment, and inflation has risen to 2%, is on track to moderately exceed 2% for some time. So if you assess the first two boxes, which, since 20 years back, I'm looking 20 years back to how things have performed and how the Fed had moved. Yes, so there is the situation where you are getting this kind of the white line, the inflation expectations moving up. And then there is at the same time that the unemployment rate had moved down as well from when things were a bit more supportive. So that for the blue line, you can see that January is about 5+% before the Fed start to lift off. So where are we now in this box itself? From what we are seeing at this point of time, yes, the inflation just really, I think, if we look at the situation in the last box over here, I think, certainly unemployment for one, we have the blue, so we have the white line over here, the inflation expectations certainly picking up for one, but on the other hand, as I mentioned just now, unemployment rate certainly is still something that's very high. And you can see that this rate is still lingering at this point of time, 6.7%. So we talked about how, the recovery pace from here could really slow, and for unemployment rate as well, until we get a lot of the sectors that's been hard hit by COVID-19, regaining that kind of pace again. So on that end itself, I think, it's unlikely the Fed will really be, coming through too strongly onto the market yet. So maybe a long way before the Fed starts to discuss this. Our good guess, I think, and I would say this is also the market consensus, is that, if the Fed really starts to taper, it will really be at the end of 2021, which is at least a good 11 to 12 months away, or the start of 2021. Treasury Secretary, I should say that now, Treasury Secretary Janet Yellen herself had also, she's also someone who's got the bipartisan support, and at this point of time, you can say that she is actually still, to a large extent, a huge proponent of, supporting more fiscal support for the economy as well, because, they hopefully, what she have with Jerome Powell, who was in her federal committee when she was the chair, have this kind of view that we will continue to see a lot of support. So the Fed meeting that you're going to get this week, listen closely, particularly in terms of how the accommodative side of things is going to look for the market. So with that being the case, coming back to this point, so these are all the items, that I am putting across to you, and that will keep tech in favor. Short-term fluctuations, however, being the case. And then, when it comes to recovery, the accommodative policies, should keep the interest in some of the laggards. So you're talking about value stocks, we talk about that, and those sensitive to economic growth. And also various indices in Asia, including the Singapore market and the likes of the UK market for the matter. Quickly as well, and one last thing I just want to highlight, it's also, I think, we talk about, what are some of the important things to watch when it go to the new year, and especially when it comes to the vaccine effect. I think that's going to be an interesting one, because this is going to be something that could really drive the recovery for nations. COVID-19 in some parts of the world is certainly getting worse. You see, people, whenever that happens, you see people starting to sell their country's equities, and then, when it gets better, they'll buy it back. And in this case of recovery, vaccine is the big part to play. So the breakthrough of what we have seen in November 2020 for vaccine had profound effects on various asset classes. This, since, November 9th here, you can see that a lot of these guys, they have picked up. So in particular, oil prices, WTI spot prices that's been used here, certainly has seen a huge jump in terms of the demand expectations pick up. And that, I think is still going to continue to be the case. But individually as well, I think, that's when whoever that's maybe trading the FX market should find this quite interesting, because I think, how they move is going to really, so who is able to vaccine more and more of their people and thereby be able to open up faster will be able to get ahead in terms of, I think, just seeing the domestic currencies really strengthening. The opposite is true for US, evidently due to the fact that they are considered a safe haven currency. So this kind of information, I put it out for you, but definitely you can Google this very easily online as well in terms of many of the progress. So really something I think, is quite important to keep track of. Now, I know we're running a little bit short of time. This is something that I've shown to be in the last round, and that was quite interesting. But I think actually for the folks here that, the good folks that I'm speaking to today at OTCS, you be maybe a little bit more expert set of audience. So I wouldn't be, going in depth into it, but just really a good reminder as well, because I think what I've spoken about so far has a lot to do with the fundamental themes and how that's going to translate to your trading. I think that's where you need to identify a lot of trends. There's a lot of these kind of assets, I think, out there for you, but I just want to show a little bit on the basics. So I think, coming to the point, and I'm going through this quickly, so give me just about 3 minutes before I take some of these questions. But the Dow theory that we have here, I think that really comes across as something that we've seen quite strongly through 2020. I wouldn't be surprised that this continues to be the case as well into 2021, because it's still a recovery year. And when you look at the likes of trend lines, it's very important really to establish some of which. So I think, one of the things that I've wanted to emphasize is due to the fact that really, I think, this is shared in my master's course, because I think it's quite interesting. A lot of finance professionals don't really look so much at technicals, but, speaking about trend lines is really a bit of a self-fulfilling prophecy. And the more people who look at it, the more clear it becomes. And I think across 2021, 2020, I should say, that really had been the case. So this is the dollar offshore yuan chart. There is like this kind of respect of that downtrend resistance, and then certainly if we translate this a little bit to trend channel, it certainly worked as well. So I think then people started asking, where exactly are we at with the dollar offshore yuan? And I would say that's also the interesting thing, because things have really shifted quite a little bit at this point of time. It's broken past that downtrend resistance out of the channel, but I do see a bit of a sideways trade really forming here. So that's the kind of picture that we are anticipating as well with the dollar offshore yuan, that really trading very strongly to what's happening in China and in the US in terms of yield movements. So that's one. But if we look closely to the like of dollar yen, for example, this trend certainly has been going on strong, and I think that could well remain the case. Now, just a slight drop on this dollar yen action. So dollar yen itself has been seeing the downtrend going on, and recently as well, the Bank of Japan, I think certainly maybe looking as well to moving the yield. So dollar yen itself is very susceptible to the yield movements. So as the US yields actually been moving up at the start of year, it did inched up, but then with the BOJ potentially looking to it as well, I think that could really be one to feed this downtrend. So yeah, just want to bring that quickly across to you, but continuing where we were. And a lot of this kind of momentum indicators is going to be quite very much useful to you, and the kind of things that we have on IG. But in the interest of time, we don't really have a lot to talk about today. But Just want to highlight this. So it's something that we have written together with Bloomberg Media that I've personally curated the kind of topics that go into this. So lots into trends, fundamentals, advanced TA, building your TA strategy. You can download this free ebook via this link. I know it makes no sense because I think a lot of people are looking at this maybe on your phones and you can't scan the QR code, but feel free to take a nice screenshot and I'll smile now. Feel free to take a nice screenshot here or just go to that link and you'll be able to download the ebook. But in any case, if you need more of these resources for clients, and even I would say even with a demo account, for example, definitely you can access my morning notes, which I will have the latest market views and what are some of the asset classes I'm watching, the trends I'm watching in platform daily for premium clients as well. We do have markets to watch and the week aheads that's given to the premium client managers. And just now I mentioned I look quite closely on the S&P 500, so that's on Tuesday. So some of the resources for you, and I tweet occasionally when important things are. I don't really tweet too much, but when important things come across, that's something I do as well. So at this point of time, I think definitely it's probably time to take some questions that we have.
Thank you, Jingy. Wow, that was excellent sharing. I felt like I went back to school, like listening to a lecturer.
Oh gosh, I hope that's not. I sleep a lot in the lectures, so I hope that's not the case.
Good one. Yeah, a lot of things are summarized, and you have condensed everything to its essence and put it in this short segment. So for any one of you who have questions for Jingy, go ahead and type it into the chat box on the bottom right hand corner of the screen. We're just going to take one or two questions, and then we'll move on to our next speaker. So in view of time, I'll just be checking on for one or two questions. Okay. So, and for those of you who have who like what you hear from Jingy and would like to be kept posted of her analysis, on the screen right now there are some links that you can take note of, and this video is being recorded, so you can also go to watch the recording so that you can revisit some of this content that she has shared. And to get her ebook, the ebook that IG has prepared in partnership with Bloomberg, is it?
Yeah, Bloomberg Media.
Bloomberg. So if you are new to investing or trading, I think this resource could be very useful to you as a first step to get started. So go ahead and download it and see how it can help you to get started. So let me see whether we can take one or two questions. Okay, one question here. Lionel is asking whether the US and China stock market are overvalued.
Yeah, actually, as I was preparing and just getting ready when Richard was speaking, I just kind of quickly brought out the two charts. I hope you guys can see this clearly. But yeah, sorry. Yeah. No, I think that's a great question because that's really I think on everyone's mind right now. Just really in terms of how the US and also Chinese market is faring now. I know this is a bit hard to see, but bear with me. So right now you have this situation with the S&P 500 index. So whenever we try to value index, for example, you don't really go so much perhaps by just really looking at individual and then try to do that, but we just try to take the PE ratio, which is how we look at it from finance perspective, and you get where we are right now, that is at around 30.8. So if you look at the blue line, that's the PE ratio. Historically, yes, it's certainly very high, but I think to a large extent as well, this actually reflects the low interest rate environment. You have not just low interest rate. Remember the balance sheet that we have seen for the Fed, they are coming through to be very supportive. So there's a lot of liquidity in the market right now, which is to a large extent why you have been seeing the way things are. I do think that this number will actually see some coming down, especially when the earnings is expected to grow quite significantly into 2021 itself. And on the other hand, when it comes to I like to use the CSI 300 because it's really a lot of the blue chip companies. And yes, if you compare maybe just 5 years back, we are certainly seeing a peak for the CSI 300. But if you compare, once again, historically, Yes, I would say that it's actually not perhaps, totally on the high side of things, but definitely I think, it's one good thing to point out for the Chinese market as well is that today, for example, we have seen a bit of withdrawal in terms of some of the cash in the market, and this typically don't really happen for the Chinese market right before like the Chinese New Year period. So I think the authorities have been looking at, frankly, I'm surprised that they're coming in so late to look at it. But, that I think what we have heard from PBOC Governor Yi Gang himself is that the economic growth remains their focus. So they're going to be moving very cautiously, in my opinion, but they could still be looking a little bit closely to the Chinese market. So some of the things that could move a little bit quicker, but in the US market, broadly, yes, I think, it does look a bit expensive, but look to where the earnings are going to pick up. And I would say those are with the value stocks that we just talked about. So think about all your financial sectors, etc., etc.
Okay, thanks, Jingy, for the comprehensive answer. So let me see. Okay, so I'll just ask one last question as
Yeah.
what you just shared, right? So given that bubbles have formed, or it seems like it's forming, but yet the people who were naysayers will say the bubble will burst, but then those who are pro the market will say that it's going to continue, it's the start of the next bull run. So what should we do? Should we just continue to trade and then watch our back and ready to get out at a slightest hint of a bubble bursting, or we should just sit and wait for the crash?
Yeah, so I think it's also a very interesting question there. Definitely, to a large extent, it depends on what's your risk tolerance and what's exactly your objectives as well. I think this falls a lot, on in terms of what exactly is your just in terms of your objective itself. So I would say that I would rank that it's important to look into some of the risk management strategies as well. I showed the US FANG index itself. That itself has been on the uptrend for many, many months. But if you have been in that and really, monitoring with what I would, personally think coming across as reasonable, putting a trailing stop, for example, that could really be the things, to signal the time that, I've taken profit at the right point of time, for example. So that of course I think is the way to go. But when it comes to what I've just discussed as well, that's I think the gist of it, that we have to be a little bit more careful in terms of navigating the market during this kind of situation. The ones that potentially could be seeing bubble, I'm not saying there is, but for example, if we look at the US Bank members just now, the likes of Tesla, certainly the market does look to it to be quite overvalued at this point of time. So you could really see to a lot of fluctuations. But in comparison, the ones that in the market still see potential, those are the ones that we want to be looking at. We want to be trading those, and we have stronger conviction with that. So I think with that, I hope I explained, and definitely to everybody, have a great time trading in 2021. I think it's going to be a good year. It's going to be an exciting one.
Great. Thank you, Jingy, for the comprehensive answer. And with that, I'd like to give a great shout out to Jingy, and let's have a virtual clap to her.
Thank you. Thank you.
So much.
Yeah, have a good evening, everyone.
Thank you so much. Yeah, thank you so much for your sharing.
Bye.
And I'll see you again next time. Okay. Yeah, have a
Thank
good
you.
evening. Bye-bye.
Bye.
And next up, we have our second speaker for tonight, and he is none other than Mr. Ian Low. He is a bonds expert, a competent trader and investor, and a dear friend of mine for many years. So he's going to touch on a variety of topics that are close to his heart. And I believe everyone who are attending right now is going to benefit from his sharing. So Ian, please take it away.
Oh,
Ian, unmute yourself. Okay.
yes, yes. Okay, you can hear me now, Richard?
Yes, loud and clear.
Okay, give me a moment. All right, you can see the slides too?
Waiting for that to load.
Let me know when you see the slides.
Mm.
Okay, you can hear me now, Richard?
Yes, I can loud and clear.
Okay, give me a moment. Give me a moment. I'm hearing my own echo. Give me a moment.
We have no echo here, and we see your slide.
Okay. Let's just start. All right. Without much further ado, hi OTCS members and everyone. Thank you for joining me. I have 30 minutes with you. Pan Jingy took some of my time, so I have to speak very fast to complete my 50 slides. All right. Okay, please bear with me. All right. I invest primarily for passive income in corporate bonds, REITs, and growth stocks. I'm a reminder with Maybank Kim Eng and the secretary of OTCS Online Traders Club. As usual, the disclaimer. But more than that, today I'll be sharing with you how I invest, my journey in this past year. It's not intended to ask you to buy any stock, but really it is what I plan to do. So if you follow me and lose money, please is do it at your own risk. All right. And please join my mailing list. It's wealthlions.com. The benefit is you will receive the slides for today's presentation, be notified of my free training on bonds, be updated on REITs with rising DPU, and you will receive slides for today's presentation. All right. 2020 is the worst and fastest crash since 1929. And it's the worst world recession since 1929 too. But you know, there were warning signs. This is the 10-year yield minus the 2-year treasury yield. This is a very popular chart where these columns here, you can see my mouse. These columns here are times of economic recessions. And whenever this chart goes below the zero, recession always follows. All right. In August 2019, it went below zero and quickly thereafter, a recession followed. So there were warning signs if you pay hit in August 2019. Now, did you make money in 2020? It was one of the hardest years for me to trade in Singapore stocks. But somehow S&P gained 16%, Nasdaq gained 43%, Shanghai gained 13%, and Hong Kong lost 3%. While Singapore, for investors in the Singapore stock market, you are likely going to be underwater at the moment. Likely, all right? Now, STI have not risen past the pre-pandemic levels yet. This is like a subset of a chart that Pan Jingy showed just now. I only have 3 charts here, the Nasdaq, the Shanghai Index, and the STI. It looks like the US Tech Nasdaq Index is a clear winner. All right. In fact, S&P is somewhere like the Shanghai, somewhere similar levels. All right, about 15%. And STI is really far away. Later, I'll be covering in detail why STI is a laggard. Now, the market direction. This book by Simon Sim, he wrote this book in 2004, where he wrote about a pattern in the Singapore stock market where it moves in roughly 7-year cycles. All right. These numbers that you see here, I'm sure you are familiar with them. These are the crisis years. Somehow, the crisis years coincide with the Joseph cycle as analyzed by Simon Sim. Here is the STI chart from 1985 to 2021. All right. This is a monthly chart over like spanning more than 40 years. You can see it's an uptrend. You know, there's a lot of naysayers about Singapore stock market that, hey, Singapore stock market is not moving up. It's staying the same. Yes, if you see here, it has been ranging for the past 10 years. Past 10 years, it is stuck in this level where my mouse is. But over the past 40 years, it has been rising. It has been rising, all right? Now, STI crashed and is now crashed last year and is now heading back up. All right, these lines you see are the crisis years where there was a crisis and they were either the market top or the market bottom. All right, and even though there was a crash last year, 2020, here you see here, in fact, the uptrend is still intact. In fact, it looks like we have not reached the top yet. The STI is on the way to reach the top. It's on the way. This is not just a 1-year trend, 2-year trend, 10-year trend. This is a mega super cycle trend, a 40-year trend. It seems like in a 40-year trend, it is still going along upwards. All right. This is the S&P 500 monthly chart, similar to the last chart by STI. It's 1970 to now. 1970 to now. This is 50 years, all right. 50 years of data here. And, oops. And do you see that where my mouse is? Where my mouse is was a crash. It seemed like a major crash last year that all hell broke loose. But in this 50-year chart, it's only a blip. It's only a blip. It's one small blip. And S&P 500 is still on the long-term trend upwards. All right. How high can NASDAQ go? NASDAQ is the most bullish of the Singapore, of the NASDAQ, of the US indices. Now, I've been asked this question and it seems that the tech stocks keep going up. So how do I come out with resistance where there is nothing ahead of them? All right. I use a Fibonacci pool from here to here to create the 1.68 level and 2.618 level. All right. So NASDAQ hit the 1.618 level. There was some resistance, but it broke through. And now it seems to be heading towards 15,000. It broke through 12,000 and it's heading towards 15,000. So I'm just speculating that NASDAQ is on its way up. But of course, it will not be a straight line. From now to the 15,000, it's likely going to be many ups and downs. All right, there'll be plenty of opportunities to buy during the dips. But actually, prediction or market outlook doesn't really matter. For myself, I just invest along with the long-term mega trend. Far more important to me, what I focus on daily in my investment journey is having a diversified portfolio, choice of goals, personal profile, and risk tolerance. This is what I focus on. I need to choose my goals, trade strategies that fit my profile, and strategies that fit my risk tolerance. All right. And I size my position sizing. I size it carefully. Don't buy too much at one time, and practice risk management. Risk management here, I mean that when I am too exposed to the market, when I think the market may be dropping, I would sell some. I will reduce my risk. All right. So basically, I make decisions so that I can sleep in peace at night. And just to share with you, in 2020 through this past 1 year, I have been sleeping very well, and I had no issues with my with investing at all. All right. And the third reason is I invest in strong growing companies. All right. And even if I don't cut loss, as it crashed through in March last year, I knew that it will come up again. All right. And in fact, the least important to me is timing the market. I think timing the market is way the market thinks that timing is so important, but I don't think it's so important. All right. Now, what to buy? Let me start off with corporate bonds first. Okay. TNX is US 10-year treasuries. All right, US 10-year is actually this is a yield chart. All right, it's not a price chart. It's a yield chart. Okay, so over here, these are the yield. So in this box here, is from 1.5 to 3%. So the US Treasury has been trading in the past 10 years in between 1.5 to 3%. Okay, and they were good years if you were investing in corporate bonds. They were very good years, but since the pandemic happened, it has dropped below, and this reduces the yield of the corporate bonds. So currently today, if there's a new issue of a corporate bond, the yield is likely to be unattractive as compared to the past. Another way to explain is this equity risk spread or premium. All right, this is the returns of investing in stocks minus the returns of investing in government bonds. This spread or premium is now wide. Now, when it's wide, you rather buy equity, which is stocks. All right, when it's narrow, you should prefer bonds. Okay, now this spread may even increase further as the Fed has guided to keep interest rate low for the next 2 years. And this results that corporate bonds are now unattractive and equities have better risk and reward. So I prefer stocks to bonds in this current market. Now, I have a if, all right? If only you can stomach the risk and volatility of investing in stocks, and if you are below 50, all right. Personally, if you are above 50, if you cannot stomach the risk of investing in stocks, you will need bonds for diversification. Okay. Now, even big funds, insurance companies, they are not going to sell their bonds, all their bonds to buy shares, but they will likely reduce their bonds and increase their shares. Just reduce, all right? Here in 2020 is my portfolio at the beginning of last year. I shared this during a similar presentation. At the start of last year, I had 70% of my portfolio in bonds and 20% in REITs. All right. In fact, at the start of last year, I had no other shares except REITs. Okay. Now, AIA at the start of the AIA PAR fund, all right. PAR fund is when you buy a life insurance, all the money that you pay to AIA, they are going to park it in this fund called a PAR fund. All right. So at the start of 2020, this was their portfolio. 70% in fixed income, 26% in equities. Very similar to mine. All right. Very similar. Now, what is my portfolio now at the start of this year? Start of this year, I've reduced my bonds from 70% to 57%, and I've increased my equities from REITs from only pure REITs 20% to equity. So I'm buying some stocks now. All right. Now, what is the AIA PAR fund now for the 2021 portfolios mix? They have not announced yet. Probably in the next quarter. All right. New economy stocks. These are currently my favorite stocks at the moment besides REITs. And by the way, because this presentation is so short, I'm going to leave REITs for Kenny Low to cover later. Okay. So on another day, I'll be covering REITs, but for this for this presentation, I shall skip REITs and tell you more about these stocks, this kind of stocks that I'm very interested now. The new economy stocks, how I define it, they are technology stocks that disrupts other businesses. All right. Have you noticed that traditional businesses are struggling, but new economy stocks are flying? Travel-related businesses are floundering, but online companies are flying. All right. If you can ask your friends who are running business, most of them are struggling. The traditional business are struggling, and they will advise you, don't start a company now. It's so hard to make money in business now. Singapore does not really have new economy stocks. All right, you take a look at all the STI, they are all traditional business. So this is the reason why Hong Kong exchange, US exchange, that their stocks are rising, because you know that for those indices, they will add the new strong stocks and you kick out the weak ones. So they are being renewed. So the new companies are added in that are new economy, whereas STI, the same stocks have been around for years. And in fact, we do have some new economy companies, but they have all chosen to list in other exchanges. I'll tell you more about them later. Let's talk about disrupted industries. I'm sure you guys will know, like for example, Netflix disrupted the cable TV. Today's Starhub's cable TV is hardly ever used now. All right, and the local telco business when is much reduced because of the mobile virtual network operators here in Singapore now. In the insurance industry, Lemonade is changing the industry there. Tesla is changing two main industry, the normal car industry, because the Tesla is the king of the EVs. EV means electric vehicles, all right, and Tesla is also the king of self-driving. Okay, self-driving because they have the most data of self-driven cars. Self-driven meaning machine AI-driven cars. They're the most data, so they are the king. All right. Meituan Dianping is the #1 food delivery company in China. They are trashing the traditional restaurant right now. All right. I put here robo investing. Yeah, these are the new way. There are many companies here, and the traditional unit trust brokers are struggling now. All right. ARK Invest. All right. They are coming up with new ideas of running funds, and they are doing much better than traditional funds. As well, as you know, iFast in Singapore, the share keeps rising fast, except for today it dropped. All right, but they are doing well, and the traditional brokers are struggling. The same way, Alibaba through Lazada is making retail shops like Robinsons, Isetan almost redundant. Then, of course, Grab versus ComfortDelGro. You know who the eventual winner is at the moment, all right? What I say at the moment? At the moment, it looks like Grab is winning, but when self-driving cars, when taxi that is driven by machines come in, maybe I was thinking Comfort may make a comeback. Maybe I'm not sure. All right, but for the time being, definitely Grab is way ahead. Now, some of you, I'm sure, some of you have not heard of a company called C Limited. C Limited is actually, lo and behold, the largest company in Singapore now, bigger than DBS. All right, and it's a company that most of you probably haven't heard of. All right, it's listed in the NYSE, and Ant Financial. They are given the digital bank license. All right. So are they going to disrupt the local bank business in the long run? I can't spend too long on this slide, but basically this is a Dow Jones chart. I can spend half an hour on this explaining, because I spend time analyzing it. But basically it's this. Okay, from 1915 till now, Dow Jones has been rising, and the world had various inventions of steam, water turbines, petrol and electricity, integrated circuit, electronics, and each time there was an invention, there was always a 20-year bull run that follows. All right. Here there's a bull run. Here there's a bull run. Here you see a 20-year bull run, a 20-year bull run here. Maybe I put Sorry, let me see a pointer. All right. Okay, now you can see better. There's a bull run here. There's a bull run here. All right. And it seems that we are having a bull run now. The bull runs are halfway there. And this is driven by the next new invention, so-called, and that is the internet. Finally, internet technology is driving this current bull run now. And we seem to be on the way up, right? With all kinds of with each invention, all kinds of new businesses are created. We are in a strong technology trend now where there may be another 9 more years of long-term uptrend. I call this a fourth industrial revolution. All right, and many people online are calling it too. But yet, you must always be careful that for people who look at daily charts, it seems that there's already a bubble. Look at Tesla. Look at the various Nasdaq. It seems way overbought. There may be a bubble, but bubble can continue for a long time. Like the property, our property bubble has continued for years. All right, so it can continue. So what is important is that there will be corrections, and these are opportunities to go in. My tech shopping list for 2021. Now you see all these counters. Actually, I have every counter here already, except Grab, because Grab will IPO this year. And I have one simple rule, and that is I buy the leaders. All right. But personally, this coming year, when I want to add to my stocks, I cannot buy any more stocks because one rule is that I want to have at most 30 stocks. I don't want to have more than 30 stocks. So I'm already approaching 30 already. So it looks like my last 5 stocks is going to be ETFs. All right. So going forward, even though I may add to these stocks if they correct, but realistically, because of management, I think ETFs are easier to manage than buying more than 30 companies. All right. So my next topic is ETF. And from this chart, the most obvious is Nasdaq ETF and not the STI ETF. All right. Now, for myself, I will not buy the STI ETF. But later you will see that half of my stocks are Singapore counters. All right. But why is that? Why is that I don't believe in the STI, but yet I love my Singapore counters? It's because my Singapore counters are in this sector or this industry called REITs. I would say that most of my stocks are REITs, or the Singapore counters are REITs, and I strongly believe in them because by its nature, Singapore's land is limited. And because they are limited, my focus is to invest in the Singapore land. All right. So I feel that there will always be demand in Singapore land. But generally, the simple principle for me is to buy the strongest. Even though, as Pan Jingy just now has shared, a common strategy is to buy the laggard. But personally, I like to buy the strongest. That is my preferred way of trading. But really, if you have back tested that buying the laggard works, by all means. I will try to diversify to tech stocks in US and China. All right. Now, why am I doing that? It's because there's 2 articles here, one by BBC and one by the Straits Times. The Chinese economy to overtake US by 2028 due to COVID. All right. And in Singapore, we also reported the same thing. Here is a chart where Chinese GDP would overtake the US GDP by 2028. All right, and this is a recent table just announced this year, all right, very recent. Okay, likewise, Singapore's, instead of when they reported, it wasn't a chart like this, it was a table. So China will be the number one by 2030, all right. And where is Singapore? Singapore right now is 39. In 10 years time, they are 37. So really, if you invest in Singapore, wow, in 10 years time, we are still roughly the same place in the world, all right. So whereas the Chinese, the United States GDP will get stronger and stronger, all right. Now, but know that when you invest in other country, there are country risks. So if you are investing in Hong Kong and US, sticking to ETFs may be prudent because you'll be diversified across a basket of stocks. If you take risks with single counter, if you're unfamiliar, you will get there will be risk for you. All right. Likewise, if you invest in Hong Kong and US, there will be currency risk. Do you know that in 1 year, the US dollar fell from 1.46 to 1.32? Almost 10%. The US dollar fell 10% in a year. So can you imagine? Many people invested in the US stocks, but actually the currency fell 10% in a year. All right. So these are the risks. I have now right now 3 tables to show you. All right. There are a lot of details here, but basically the blue ones here are what I plan to add. All right. These are the traditional ones. These are what I plan to add. And one point to note is that the QQQ is a passive index, whereas ARK Innovation ETF is an actively managed index. All right. Due to the time constraints, I cannot tell you more about the focus on disrupting innovation. For Chinese ETF, there's basically two ETFs I'm looking at, the CSOP A50 ETFs. This is the stock code. Okay. Now, notice here SIP. SIP means specified investment product. It's only for traders or investors who have passed the SGX test or who have declared themselves who are experienced, who have traded before. All right. So if you are inexperienced investor, you are beginner, you cannot trade such a counter. Instead, you have to choose the UETF SSE 50. All right. Because it's excluded investment product, so allows anyone to buy. In fact, you can use Singapore dollar and even use SRS to buy. Okay. In fact, I have this, but going forward, when I want to add, I will be buying this instead. All right. Now, I also want to add to Chinese tech stock. All right. The Chinese tech stock is listed in Singapore. All right. This is a Singapore counter. It is actually a Hang Seng Tech Index. Okay. It's also excluded, meaning that anyone can invest. And you can even use SSRS. Okay. But for those who wants to use Hong Kong dollar, you can buy the CSOP. In fact, there is another counter that is in renminbi. If you want to buy the renminbi version, is 83033. Just add an 8 in front. All right. And of course, the currency here will be renminbi. And note in this, you know that for the Chinese government is coming out with competition rules. All right, they want to come down on Ant Financial, Alibaba. You know what? This is good for the tech index because when they come down hard on the leaders, the rest of the tech companies will benefit. And this is the other ETFs that I look at. All right, the gold ETFs here. Now, although I put gold ETFs here, I've been looking at it for years, but I somehow, even now at gold at such high prices, at such lofty prices, I know right now it's inflation and it's likely to rise some more, but I don't see myself buying somewhere that high, almost 2,000, almost there, 1,007 to 1,000 to 2,000. This kind of prices, I cannot hold for 10, 20 years. In order to buy and hold gold for 10, 20 years, I have to buy at close to their cost price. All right, okay. So there is a cost price for gold, and it cannot go too much above their cost price. There's always a limit. All right. But for myself, my focus will be on TLT bond. All right. I would like to keep 10% of my equity portfolio in bonds. Okay. Currently it's at 4%, so I will need to add. At one point during the pandemic last year, I had 20% in TLT. Okay. Right now it's just 4%, and I want to add to about 10%. And there are like 5 or to 6 other ARK Invest ETFs. All right. And I want to add to them too. When to buy? Okay, I can't cover too much, but basically I cannot explain the stochastic hook at this time, but should show you an example. What will my entries be? For the stochastic hook entry, this is an STI over the past 2 years. I'll be buying at such points. All right. So it allows a person to buy low. Of course, the stocks can drop further, but at that point, it is the lowest of that period. All right. So you'll be buying here, buying here, buying here. Here it drop, you can go in again, going and going again. So this is the stochastic. It helps you to buy low, correct? And you average in your entries. Alphabet, which is Google. So this will be the entry, the possible entries over here, over here, over here, over here. These are the weekly charts. I trade the weekly chart only. I don't look at the daily chart. Likewise, Alibaba, they just have the entry here. You can go in here, you can go here, you can go here, you can go in here. All right, very nice. So this is my favorite. Okay, so let me move on. Now I showed you the first method, and that is a stochastic hook. All right. There's another method that I used most of the time last year. In fact, majority of the time, and that is simply to average. I average so often. Okay. People say timing is everything. Don't average in. Never average in. Well, I'm averaging in, and it has worked for me. But I have a few rules, and here are the rules that I have. If you ever average in, there's one criteria. If it's a losing stock, it's keep coming down. The stock you must be willing to hold during a crisis. All right, you cannot hold a stock like Blue Mon that keeps dropping and dropping, or any small cap stock you cannot hold, any mid cap stock to me you cannot hold, but only a strong stock. All right. So when you repeatedly buy a stock, you must have a strong reason why you believe it will recover after a crisis. So I only average in on stocks that I believe it can ride through a crisis. All right. Next, I must be prepared to lose all the money invested. All. I here is all. All right. Now, my maximum investment allowed, actually, each time when I go in is 0.5% to 2% of my AUM. So just about 1% of my money that I have set aside to invest in stocks, I only go 1% or even 0.5%. All right. For example, Google, Tencent, 1%, Tesla, Meituan, 0.5%. Of course, for my REITs, I will go 2%. All right. Now, for example, if I wanted to deploy 500K, I will aim to buy 20K per week on average. When the sentiment is good, I may even buy 30K per week. But the sentiment is bad, I don't buy at all. But basically, if I have 500K, if I on average invest 20K per week, in 6 months, I will invest all the 500K over 6 months. I will not take 500K to invest at one shot. All right. I will spend 6 months to go in, to average in. And frankly, this was what I did. All right. Now, this is the STI from in 2019 till now. I decided actually in 2019 to start recording my trades. Now, of course, I have been investing for a long while, all right. But somehow I thought, hey, let me record and see, and so that I can, tell people about it and see. But I started here. So can you imagine if I started a portfolio and started buying stocks here? Can you imagine what my portfolio will look like now? And they are mainly in Singapore stocks, right? You would think it's underwater, correct? So it suffered a drawdown of 34%, and that was how much STI dropped. Now, here's my return, all right? So I started here. The blue line is my performance. The STI is this other. So STI came down, and this is 2020. It came down, and now it hasn't come out to pre-pandemic levels. All right. So while STI came down, my choices of stock came up. But still, because of COVID-19, it crashed. And lo and behold, it's back up again. All right. Now, please note that I'm not showing off at all. In fact, there are many people who did better than me, of course, and especially those who start measuring from many people. I noticed on the internet, many people boosted their returns because they started to measure from here. You started to measure from here, you will have easily 50% returns. All right. So I practically started on the high, and this is my result. I'm only up for 15%. All right. Okay. But really, my performance is not too great. Other people have 50%, 80%. Some people is underwater. All right. But really, don't compare. Don't compare, because every investor have a different start date. Every investor is risking different amount of risk per trade. Some are taking risks. Some are very concentrated. All right. Some are on leverage. And some are having lots of drawdown. They suffer a lot of drawdown. All right. So my portfolio was only 15%. All right. So different counters have different kind of volatility. So it's very hard to compare. All right. Now this is now currently my portfolio now. All right. So I have 50% in REITs. 25% in tech stocks. I have maybe a good 20% in bank stocks, Singapore banks, and this is the rest. So through COVID period, I increased. I bought mainly tech and bank stocks. All right, and some REITs. Currently, this is my top 10 holdings. I'm sharing with you openly. My biggest portfolio is Fraser Centrepoint Trust, UOB, CapitaLand Integrated Commercial Trust, Link REIT, Capital DC, DBS, Meituan Dianping, OCBC, Tesla, and Mapletree Commercial Trust. All right. So these are my top 10. And you ask me why I don't want to buy more Tesla, why I don't want to buy more Meituan. No, in fact, I want to sell them to reduce them. All right, I want to reduce them to about 2%. Okay, so that is my intention. You know why? A lot of people just want the gains, but they are not looking at the risk. For me, I'm not interested in making a lot of money. I'm interested in reducing my risk. So all the time I look at trade management, manage my risk. In fact, when I cut loss, it's not because it fall below a certain price. I cut loss whether I make profit or I sell. When I sell is because I want to reduce my risk. risk reduction is the most important. All right, 2021, these are my assets that I'm focused on. Basically, I'm focused CPF. Actually, I'm a big believer of CPF. I'm 50 this year. In 5 years' time, I will get back my money. So any money I put in, I will have at least 2.5%. So it's better than any government bonds now. All right, 2.5% is better than any fixed D or government bond. So CPF is one of my key tools now. TLT is what I use to reduce my beta or my volatility. I want I want my portfolio to be less volatile, and TLT will help me to do that. And my retail and corporate bonds, I will either hold or I may even sell a couple of bonds. All right. If there's opportunity to buy stocks, I may sell a couple of bonds and take the money to buy stocks. And by the way, how did in 2020 how did I manage to find money to buy shares? I was fully invested. How did I find money to buy shares? Because I sold my bonds to buy and I took the money to buy shares. All right. Here, and of course, I'm focused on REITs. So currently in 2021 for normal stocks, I am dividend stocks. I'm only looking at REITs. Bank stocks, I think, is too high for me. I'm not touching bank stocks now. It's only REITs and the tech stocks. All right, and the tech stocks. Okay, so my plan for 2021 is to prefer equities to bonds, invest in strong companies. I want to add REITs. I will not sell my REITs. It's an opportunity for new economy stocks and ETFs. And the mindset that I must have throughout for 2021 is I must, instead of focus on trend direction, I want to be focused on having a diversified portfolio with disciplined position size and risk management. Be patient and wait for risk and wait for correction. That's all for me today. Join my mailing list again. These are the benefits. Receive slides for today's presentation. Be notified of free training and be updated on REITs with rising DPU. Thank you for your time. Richard, take over.
Wow, thank you so much for your comprehensive and clear sharing. Yeah, you're always so clear, you know. So I think if you explain to your 3 kids now, they can understand.
Thank you.
Thanks, Ian. So for the attendees here, if you have questions for Ian, please feel free to type into the chat box right now at the bottom right-hand corner of the screen. So please go ahead and type it in. And I'm just going to pick maybe 1 or 2 questions to ask because we are running behind time. Please be prepared that we're going to stretch till maybe 10:30. Okay, so let's hear some. Let's get some questions from the floor. Let me see. Yeah. Okay. All right, Ian, you have a fan. Lindsay say applauding. Thank you, Ian. Amazingly clear.
Thank you.
Okay. Arun is asking, what's your take on First REIT?
Okay. First and foremost, I will say that I do not plan to invest in First REIT first. It's because my focus. I'm not showing my slides here for today for her REITs. Okay. Now, if you see the what to buy for my REITs, which I plan to share soon, all right, my what to buy for REITs are all stocks that is above 1 billion in market cap. And they are basically they are the Maple Trees, the Capital Lands, all right. They are the largest, the Ascenders, the Link REITs, all right. So I will not touch stocks that are more like small caps. Okay. But having said that, I think the worst is over for First REIT. Personally, the rights price at 20 cents. If there's only one stock in the world and you're asking me whether to invest in First REIT, I would say yes. If there's one stock in the world, it's either invest or don't invest. I would say go ahead and invest in First REIT because 20 cents is cheap, and going forward, things can only get better. There is now no unclarity or murkiness going forward in first REIT. The contracts are all signed. The income support are all declared. The rights issue has been done. They have raised enough money. The only slight unclarity is the rupiah Sing dollar fluctuation. All right. So for example, okay, I am having a ballpark figure. If you buy at, let's say, at 20 cent, 20 to 25 cents, all right, I think your dividend yield going forward will be about 12%. All right. You get 12%. But then there's a fluctuation of, let's say, 4% for USD rupiah. So you 12 minus 4 is just 8%. So realistically, you may only get a 8% return by investing in first REIT between the price of 20 cents to 25 cents. So if you're happy with that, go ahead. All right, Richard, next question.
Yes. Okay, great. Thank you. And okay, Philip also said that great presentation, Ian, as always.
Thanks.
Okay. Yep. Let me see. Okay, V is asking, S27, he thinks that it's not so liquid. Any issues in buying the ETF? And that will be the last question. Yeah.
Okay. I totally agree. S27 is not so liquid, and because it's listed in Singapore. But okay, if you are buying today and sell 1 month later to 3 months later, I would say don't choose S27. All right, because it's the spread is wide. When you want to buy, the bid and ask spread is wide, you are paying slightly more. Okay, but why I put it there is because you can keep in CDP. You can keep it. This is so important, all right? Whereas if you buy the other counters, it's kept in custody. Custody is another set of problems. Personally, the first choice, I always prefer to deal with entities that can be kept in CDP. The moment it's custody, I need to evaluate the counterparty risk. Okay. So I hope I answered your question.
Thank you, Ian, for the very excellent Q&A session. And please remember to join his mailing list at wealthlions.com. Thanks, Ian. And
Thank you.
yep, okay, great. So now we'll bring on the last speaker for tonight, and that is none other than Mr. Kenny Low. He is also my REIT Sifu and a buddy for many, many years. And today he's going to share with us his market outlook as well as his insights on the S-REIT market. So Kenny, can you take over the stage, please?
Mic check. Can you hear me?
听到，听到，听到。
听到，听到。
哎，等你的 slide 出来。哎，你的 video 好像有一点慢哦。
Can you hear me?
啊，听到。
听到我的
video
slide
like 啊，还没有。
Yeah, the screen is loading.
嗯
You can see
wait for a while.
547. Everyone prepare to. I have 30 slide. I think this is the first time.
等一下
Small slide.
the screen loading got error 你等下那个 WiFi 有一点不好哎。
Okay, I share again.
啊，你 try again. Okay, while waiting for Kenny to come back into the room. Oh, he's back. Okay. Maybe it's a time of the night where the internet traffic is getting congested. Okay.
Richard, can you hear me?
Okay. Oh.
你听到我讲话吗 ，Richard？
OK，听到你讲话，我看你 off 那个 video 可能会 save 一些 bandwidth，好像是你
OK
internet 可能internet 的那个 speed 好像比较 slow。Okay, in the new age web meetings, we have new age problems, which means that we depend on the technology working. And one of the pieces that is very critical would be the internet connection. So if the internet connection is not good, then yeah, things like this can happen. Okay, let's see. What do I see? So sorry about it to keep you waiting.
Richard, can you hear me?
Okay, better now. Your sound is more continuous. You try sharing your screen.
Okay, the screen is on. Can you?
Wow. Still not very good. 没有看到 slides.
slide 出来嘞。
Oh, it's very lagging. 声音 also breaking just now.
Well,
Testing.
okay,
Okay, 来，我继续一下。
1, 2, 3. Testing 1, 2, 4.
Not very good. You want to try using your mobile data? Don't turn on video.
Okay.
Try 一下。
Okay. We'll switch to mobile.
你 switch 一下，你 try 一下。Okay, while Kenny is settling his small technical issue, let me just do a quick reminder for everyone who are here. If you like what you hear tonight, please support us by joining the Telegram channels that you see on the screen right now. Online Traders Club, you can search for that in Telegram. Wealth and Joy, and Retirement, which is Kenny's Telegram channel where he shares about his REITs updates and insights. All right, and then wealthlions.com will be where Ian blogs. Just now, you also saw that he talked about the stochastic hook, how he buys stocks using a stochastic hook. He explained it in one of his blog posts. So if you want to find out how, please go to wealthlions.com and check out his education section there. Okay, and join his mailing list so that when he have additional sessions about his outlook or his insights, he will share with his mailing list. Okay, Kenny, I see that you're back in the room.
Yeah, I'm back. I'm share again.
Oh, sounds so much better now.
Okay, can you see? Much more faster now.
可以
Okay.
就是 internet 啦。
Internet. I swap the browser.
你用哪一个 ISP 啊？
Singtel.
Okay, I'm using StarHub. Just now Ian one was very smooth. Ian, I think he's using M1. Yeah, they'll take turns.
Okay, I skip all this thing 啦。Okay.
还没有出来，等多一下子。
出来没？有了，出来了。
这边等一下子。
我看到了的那个 screen。
看到了哈。
奇怪，你那边没有出来。
还没有出来了。OK， 可以。
Okay. Yeah.
Okay, over to you, Kenny.
all right. Just a little bit of myself. If some of you don't know about me, I'm a certified financial planner and also the REIT specialist of an independent financial advisory firm. I am currently overseeing an 8-figure investment portfolio for about 100 clients. Of course, most of them that actually they ask me to help them to advise on their REIT portfolio. At the same time, I'm also the investment coach and also the S-REIT strategies for Adam Cool Learning Technology. And I am also the SGX trainer, helping SGX to promote the Singapore REITs to the overseas investor. And at the same time, I'm also the IBF certified trainer, training a financial advisor, financial planner, the private banker, and also relationship manager. Those are on the professional side. So I have run my own blog. This is my stock investing. You can go to my website to take a look on my monthly update on the REIT itself. Okay, where to find me? If you want to find me, these are the places you can find me. This is my website, mystocksinvesting.com, and you also can find me through the Facebook fan page. I'm also having a Telegram channel. You can scan the QR code and you'll be joining the channel. Okay, you can do it now or maybe at the end of the session. But if you have any question you want to reach me, and also because we don't have enough time to answer all the Q&A, you can drop me the email at kennylaw@fapl.sg. All right. So let's look at the current performance of the S-REIT for the past year. A bit lag, so I'm waiting for a slide to show up before I proceed with the presentation. As you can see from the chart over here, actually Singapore REIT index has rebounded strongly since the market crash in March 2020. The rebound has been fast and furious, about 50% as of yesterday data. And FTSE ST REIT index actually outperformed the STI since the market crash, giving us about 37% in terms of return, and financial 32%, and also the STI 25%. Okay, I would like to recap on the last market update I have done on the Money FM 89.3 on March 20th. If you can remember, actually the REIT sector bottom on March 23rd. Actually, just nice that is one day before the market bottoms, right? During that interview, actually, I mentioned that this is a once in a lifetime to invest in Singapore REIT, right? Because more or less that the market has bottomed. If you have followed me in the interview or back then, probably you are sitting a very nice profit on a Singapore REIT. Okay, so you can take a QR code to go and listen to the past interview with Michelle Martin, and you also can go to my website here. I have the recording on the interview itself. On on April 2nd itself, and also by invitation of the OTCS, I also provide a webinar to share about the COVID-19 crash, risk or opportunity to hold REITs. Okay, that's why this video is on the YouTube. You can go to the YouTube to view this about 2-hour market analysis. All right. During that time, I also share with the participants that during that time actually there's a huge opportunity to start investing in REITs. So those recorded video or radio, those are not the after fact analysis, right? Those have been done during the market crash, and this is where we are today. So recently, probably you have been seeing there are many people start talking about it's time to invest in REITs after the market has been very bullish. I would say that actually the best time to invest is during the market crash, and also during a recovery. Right at the present moment, although the REIT itself is still on the upside, but in terms of capital appreciation, they actually have a limited upside for the time being, right? But it's not so late. I will share with you what are the opportunity during this period if you have missed the first boat. This was the slide I have shown during the last webinar, right? I mentioned that in the macro environment, we are under the ultra low interest rate environment, and also we have plenty of QE unlimited. And during that time, I also share with everyone, actually the REIT manager itself will use this opportunity to aggressively go for acquisition due to the cheap money and also the cheap valuation. And that time, I'm also giving some heads up that actually investor should look at the opportunity for those REIT with a strong fundamental and trading at a historical value at a discount, also have a long-term growth potential. All right, mean the REIT manager itself aggressively go for acquisition. Okay, so you can see from here what is the current situation today. At the current present moment, the macro environment is still operating in a very low interest rate environment. It is expected the low interest rate will continue to stay throughout the 2021, and based on the forecast itself, you won't be surprised that the low interest rate will continue into 2022 and 2023. This year, although that we are on the gradual recovery on a global economy, but probably most of the time for human being and the whole world is fighting the COVID-19, although we have a vaccine. So the actual recovery probably will only come in 2022. If you look at a 10 years government bond yield on the Singapore 10 years bond yield and also the US 10 years bond yield, which is operating at about 1%. Okay, you just imagine if you park the money in the bank, you need to park there 10 years just to get the 1%. This is what it means. All right. If you park shorter than that, actually your interest rate is pretty low. It's definitely lower than 1%. And during this period, all the central government, for example, in US itself, is pumping a lot of liquidity, printing a lot of money into the system in order to kickstart the economy again or rescue the economy again. That's why you can see that actually in US itself, the US Federal Reserve is pumping close to 7 trillion that kind of money into the market. And Bank of Japan also ramp out the QE during this COVID-19, plus European Central Bank also pumping a lot of money into the system. Okay, all in all these things actually provide a lot of liquidity in the market. There are so much money in the market, and eventually, all this kind of excess liquidity will flow into all the real estate, for example, REITs and stocks and all other asset classes. That's why that's the reason that you can see that there are so many asset classes, commodity, gold, everything is going up, one way up. So in order for the investor to really capitalize on this kind of excess liquidity, investors should take this opportunity to look at what are the asset class to invest moving forward, right? So because if you don't participate in this kind of so-called bullish environment, you probably will miss out a once in a lifetime opportunity for the investment. And this has already been happened. I mentioned about the cheap money supports the merger and acquisition. This has happened for past year in 2020. You can see that actually the merger of capital mall trust and also capital commercial trust become the capital integrated commercial trust, which is the largest REIT in Singapore and also second largest in the APAC. And you also can see that Ascendas REIT recently just expand the mandate, acquire the offices in Australia. Just bear in mind that all the while Ascendas REIT is pure industrial play. Okay, it is quite surprised to me that they expand the mandate, go and acquire the office. All right. And Mapletree Industrial Trust and also proposed to acquire a data center and also the office. Data center is not new to MIT, but office is really new to the Mapletree Industrial Trust. Okay, it's also interesting development. And MLT, Mapletree Logistic Trust, recently also announced 1.9 billion to acquire another 9 logistic property in China, Malaysia, and also Vietnam. And Capital China Retail Trust, this is another surprise to me. All the while Capital Land Retail China Trust, they are focusing on retail mall in China. Now they are expanding the mandate to so that they can go ahead to acquire the business park, as per usual, the shopping malls and also the office in China. If you read in detail the mandate itself, they even have a flexibility to invest in a data center in China. So keep a lookout for this CRCT. It will be, I think that this will be pretty interesting in the future development. Okay, land lease, a quiet gem, and also there's a car park space at the Orchard Road. Okay, near the Somerset MRT. Okay, and ESR tried to merge with the Sabana REIT but failed. Soy Build REIT delisted from SGX on a buyout offer. That's why there are private equity coming in that even have a money to really delist the Soy Build REIT. Okay, they are all these things are driven by the liquidity in the market. ARA Logos Logistic Trust also acquired the 5 logistic property in Australia. Okay, that's why I think that this M&A will continue to happen under this cheap money and also cheap valuation environment. Okay, of course, not everything is looks great. During this COVID-19, this pandemic also exposes some of the weaknesses for certain REIT. For example, Eagle Hospitality Trust actually default on the loan payment and file for Chapter 11 bankruptcy protection. Is expected to sell the hotel moving forward. Okay, this is the first REIT listed in Singapore have filed for bankruptcy. Okay, first REIT has to restructure the master lease agreement with a sponsor and issue right at a huge discount. The discount is huge, right? To recapitalize and also strengthen the balance sheet. Lipo Mall Indonesia Retail Trust issue right and at a huge discount also for the acquisition for the new mall. Right, these 3 REITs are were the worst performing REIT in 2020. Okay, if you look at the whole 2020 investment, if you are the REIT investor and if you have taken action during the market crash or during the rebound, anyhow you throw a dart in any REIT, of course you need to diversify the portfolio. You will make money, right? So the key question is whether the investor have taken action, have done the homework, and also trigger the buy button, and also diversify into those fundamental strong REIT, right? If they do, they definitely have make quite a handsome money. Okay, let's review on this rebound of the FTSE ST REIT index. Okay, basically I classify into 4 stages recovery. We have a flash crash. Okay, within 3 or 4 weeks, it dropped close to 40%. And after that, followed by a strong rebound. This rebound was led by the big cap industrial REIT and Parkway Life REIT plus a cable data center. Basically, there are these five big cap REIT power the whole rebound. And after that, the REIT index itself go through 7 months consolidation period, moving nowhere. Only recently, start from December period, the REIT index itself start to show that the uptrend has been formed and started on an uptrend. So if you look at the REIT index itself, just now Jingy to show you some trend line itself. If you know how to use the moving average to identify a trend, you can see you can start to see that actually the FTSE REIT index has started an uptrend recently. So if I look at moving forward using the technical analysis, what would be the future direction for the REIT index itself? Okay, first of all, if you can see from here, the 3 moving average are trending up and started the uptrend. Recently, the REIT index has going through the minor correction. Currently back to the 20 days moving average, right? If this moving average can support the retracement, form a support, probably the uptrend will continue. Okay, and my expectation is, I think that this REIT index itself probably will break new high by end of the year. Okay, support by the plenty of liquidity in the market and also the low valuation plus the return of the rental income and also the dividend. But if you look for longer term, I'm expecting the REIT index to reach the 1,200 point. You can see that actually there's a Fibonacci expansion level of 1.618, right? So short-term target, you back to the pre-COVID high, 982 points. Long-term target, maybe for the next 3 to 5 years, probably you'll be hitting the 1,200 point. Okay, it depends on how the low interest environment being forward. And why am I saying so? Because REIT has a tendency to enter into a multi-year bull run cycle under the low interest rate environment. If you look back at the REIT performance, start from 2004 to 2006, that was the bull run before the market crash in 2007 and 2008. After we recover from the global financial crisis in 2009 onwards, under the low interest environment, you can see that REIT sector actually is one of the best performers year over year, continuously for the next 7 to 8 years. All right. Recently, of course, in 2020, we have a flash crash and immediately the REIT index itself rebound. If this pattern repeat itself, I would expect the REIT index and REIT sector will continue to do bullish for the next few years. And what would be the REIT sector to watch in 2021? Right? If you can recall, just now I have presented the 4 stages recovery. The second stage recovery was driven by Ascendus REIT, Mapletree Industrial Trust, Mapletree Logistics Trust, Keppel Data Center, Parkway Life REIT, the best 5. There used to be a best 5. And past two or 3 months, actually there was a sector rotation from this best 5 to the hospitality and also the retail sector. Okay, that's the reason that you actually can see that Air REIT, MIT, MLT, KDC, Parkway Life, actually they're coming down, right? And this present an entry opportunity. Okay, if you are able to use technical analysis to help you to time the entry, there may be some opportunity for this big cap REIT. Okay, and also retail has been on a strong, very strong bullish run during this recovery. Hospitality is taking a pause after the recent strong run up. For the past 2 or 3 weeks, actually, hospitality sector actually going through the correction now. Okay, and I'm also seeing that actually small and medium cap start playing and catching up. So in short, basically there are opportunity everywhere this year for the REIT sector, but not all of them are the best pick. So this year has to be more selective compared to last year, because last year basically the focus is more on the capital appreciation, but this year probably the capital appreciation is limited. But the main focus has to go back to the dividend play again. Okay, I just show you some of the data on in general on the REIT itself. If you look at this table itself, I have the price to NAV for the top, the lowest 20 price to NAV REIT in Singapore, and also a price to NAV 1-year chart and 5-year chart. You can see that actually quite a number of REIT, they are still undervalued at the present moment. Okay, and if you look at this example, for example, Mapletree North Asia Trust, at the present moment, the yield is about 6.21% and gearing for 40%. If you can see the number itself is just too small, but I want you to pay the attention to the price to NAV, the historical range, right? Probably you can see the red line over here. The red line over here represents the average price to NAV. During the market crash, actually the price to NAV for Mapletree North Asia Trust is trading 2 standard deviation away to the average level. Actually, during that time, based on the valuation itself, is the best time to enter, because at the end of the day, investing in REIT is investing in the real estate, right? No matter how as an investor, we always want to look for undervalued real estate to invest. So by using this price to NAV historical range, more or less you can know that when is the right opportunity to enter. Okay, at the present moment, some of the REIT has already closing out this price to NAV and go back to the average level, right? That means that the REIT itself not expensive and also not cheap, is at the normal range. Okay, there are still opportunity out there. Another type of example would be Mapletree Industrial Trust. Okay, you can see that actually Mapletree Industrial Trust on this bottom chart price to NAV range, he has been rarely too much, is away above the plus two standard deviation. That means it's extremely overvalued during the time. And recently, the price to NAV actually has come back to the one standard deviation. Okay, represent an good opportunity to really maybe can take a look again, right? And you can see from here, this chart itself, the price to NAV has been on rising trend. Okay, so one of the things that investor need to take note that don't pay too much attention to the past data, right? Because recently Mapletree Industrial Trust has gone through many acquisitions on the data center. When you have a data center in the portfolio, the valuation is different. They're always traded at a premium. So probably the norm will be the existing price to NAV for the past one year. That probably will be the new reference point, right? Okay, then the third example would be some of the REIT, they are still trading at a historical low price to NAV. You just look at the first REIT itself. Okay, although first REIT has many negative news, but if you purely focus on the valuation itself and also focus on some of the financial itself, the price to book is basically trading way below the historical average. So pretty attractive. But like what Ian said, that probably we have to wait for the whole right issue to finish and to let everything stable down. And after the debt restructuring and also master list restructuring and see how it goes. All right, there may be an opportunity for first REIT to come back to life again, especially they have already announced there will be increase that the mandate or changing the mandate to invest in those hospitals in Australia, Japan, and also Malaysia, right? That may be another pathway life REIT come into play, right? This is just an analysis. Whether they will execute as per what they say is yet to be seen. We just need to see how first REIT going to recover after the right issue. So this is a summary of the risk and opportunity. Okay, I summarize everything into a few key points. Ultra low bank interest rate is expected to be low moving forward. And there is a high risk of eroding purchasing power due to inflation, because you just imagine that every central bank in the world, the major economy is keep printing money. They will follow the huge inflation moving forward, all different type of asset class. And Singapore REITs will continue to grow, and the growth will accelerate under the ultra low interest environment. You have already seen there are so many M&A happening. With all the new property into the portfolio itself, there will be the increase in the rental income. The rental income will give us a higher dividend. When a dividend is increasing year over year, quarter over quarter, the share price will continue to follow through. And NAV is expected to raise again with the return of rental income and DPO. Last year, actually, quite a number of REITs itself, they have a reduction in NAV due to the valuation of property, because the valuation of property is very much depends on rental income. When rental income forward guidance is poor, the valuation of property will be lower. Okay, that is just a pure formula, right? Moving forward, if they are expected the rental income will come back, there will be the re-rating or revaluation of property value that will support the NAV. If the NAV goes up and your share price, you more or less you follow the upward trend. So for the investor need to have a long-term investment horizon and have to look beyond the current recession caused by the COVID-19. We cannot just read at the news itself and also after they make the investment decision, because the stock market and also economy, they are not moving hand in hand. Stock market always moves 6 to 9 months ahead of the economy. There are still some upside potential in the selective REITs due to the attractive valuation and also the increase of dividend moving forward. So the keyword here is selective. You don't just go in and throw a darts to any REIT, all right? Some of the REIT, the valuation is not so attractive already, because most of the REIT has run up too fast, and also there's not much room for upside. And REIT is one of the best asset class in your long-term investing portfolio. Okay, I will show you. This is the chart published by JP Morgan Asset Management, right? They are compiling the performance for past 20 years performance of a different asset class. You can see from here that actually REITs has the highest annualized return, close to 11.6% total return compared to other asset class for the past 20 years. It's much better than gold, 8.6%, S&P 500, 6.1%, 60-40 balanced portfolio, 40-60, so on and so forth. So if you are a serious investor, you should seriously consider include the REIT into your portfolio. So I come back to this chart again. Where are we now? The best time to invest was in March, April, May 2020. That was the first boat. Now the market has already recovered. We are on the recovery mode, and we are at this stage now. You can see from here, we are here. And it's expected the dividend, you continue to increase from here onwards, and the increase in dividend, you continue to propel the share price. So the question you have to ask yourself is, have you missed the boat during the first wave? If you have missed the boat, you have to ask yourself, why did you miss the boat? What lesson learned you have to learn from it? Because the reason being is the best time to invest is during the market crash, because that is the time that you can buy good stuff at a huge discount. So if you don't want to miss the next one, you can email me if you need help, right? You can email at kennylaw@ffpl.sg, because I don't wish every one of you to miss the second boat again, right? That's all for my sharing today.
Right. Great. Thank you, Kenny. Thank you for the great reminder. And it's interesting that we had several webinars with Kenny down through the past 12 months, and it's also found in our YouTube channel. You can go back and revisit it, and exactly what did he say back then during the COVID crash, you know, what he would be doing for his clients. And so all these are not on hindsight. What he said back then was not on hindsight. So it seems that on this chart, he's saying that we are just coming, you know, we are at the late stage of the COVID, maybe coming out of it, and there seems to be still a leg to go. Is that what you meant by that circle there, Kenny? Yeah.
Okay. I just want to repeat again. Okay, the reason that actually the share price you still continue to have some upside. First of all is the return on the dividend, right? The return on dividend, of course, you attract a lot of investors come back to the REIT sector again, especially those bond investors. Yan also mentioned that because the bond yield is pretty low, right? We are talking about investment grade bond yield of about 2 to 3%. And for REIT itself, at the present moment, easily you can find any REIT between 4 to 8% at the present moment. Of course, enter at the low price, you can buy the REIT at huge discount, and when the return of the dividend coming back, and of course your overall yield you increase also. Okay, that's the first reason. The second reason probably you'll be the plenty of liquidity in the market. And if you look at the global REIT sector itself, actually the fund manager, they have not really rotated the money into the real estate sector. Okay, the money is still in the technology sector, right? And I think that this year, probably there'll be some of the liquidity. You'll be rotate from this technology sector back to the value stock again. For example, financial sector and also the REIT sector, because these are the sector they are lagger in 2020.
Right. Thanks, Kenny, for the additional information. And if you have any questions for Kenny, please type them into the chat box that you see on the screen. For if you're using a desktop, it'll be on the bottom right. If you're using a mobile device, then you have to scroll up or down to look for the box. And we'll be selecting 2 questions to ask Kenny in view of time. So let me see what would be the first question. Okay, YT is asking, can we still invest in that best 5 REITs? would they still be the best bet for 2021?
It's very much depends on the valuation because investing 101, you don't invest in something which is overvalued. So during this correction, some of them present you the entry opportunity, but the entry opportunity you have to capture it fast. They will not retrace until one level and wait for you to buy. Okay, because most of the investor out there, if they know how to do the valuation itself, they do some comparison, then they know that this level is a good entry point, and immediately they will scope it out, and after that they'll rebound again.
Right. Okay, cool. So I hope that answers your question, YT. And let me see. Okay, let's end the session at 10:30. Okay, so we'll pick because there are quite a number of questions, so it'll be hard to choose. Okay. Danny is asking, Capital DC REIT was up 66% in 2019 and about 38% in 2020. Do you still see a strong performance moving forward, like this year or beyond?
Based on the current portfolio and dividend, I think that the upside is limited because now Capital DC, the yield is only 3.something%. The yield spread is not so attractive compared to other REIT itself. Right? If they don't have a strong performance or surprise increase on the DPU through a new acquisition, I think that Capital DC, the upside is limited. Okay, and based on valuation itself, is pretty expensive if you look at the historical price to NAV range.
Right. Okay, great. Danny, I hope that answers your question. And Joe here is asking, can you share how can we reach out to you to help us create our REIT portfolio? Now, incidentally, if the attendees and friends here do not know, Kenny is the person that every educator out there is talking about. And what do I mean by that? Now, every educator in the market is going to say that, their course is for educational purposes only. If you need help or if you need advice, please talk to a qualified financial advisor, right? So Kenny is a licensed, MAS licensed and qualified financial advisor that can help his clients to construct portfolios. Right, so he is the one that every trainer out there is talking about. So if you need help in your portfolio and you don't know what to do, you have a laundry list of stuff that you need help to clean, or you want to go into REITs and don't know where to start, how to start, then maybe that will answer Joe's question. How can they reach out to you, Kenny?
Yeah, okay. You can see from here that you can drop me an email, kennylog@ffpl.sg, and explain to me what help do you need, and if you need me to help you to review a portfolio, I can help you to take a look in the portfolio itself and recommend the next step for you to take.
Okay, wonderful. And Kenny also have a Telegram group, so a Telegram channel, not group. Group is very noisy. So Telegram channel where he shares his REITs insights. So I've already shared about that in the beginning of the video. So if you need to see what is the link, I will drop it in the chat box later on. So let me move on to the next question, and we have 3 more minutes before 10:30. And the next question is, let me see. Okay, E is asking, is there any more upside in the price and dividend for Parkway Life REIT?
Based on the valuation itself and based on the distribution yield itself, at the present moment, I don't think there is a lot upside unless they go for acquisition again, right? Actually, in the REIT space itself, everything is come back to what will be the future dividend. If there is an increase in future dividend, definitely there will be a upside. If the dividend is stagnant, no growth opportunity, no growth potential, probably they also will not support a share price.
Right.
So it's very important to really look at all this kind of historical data. You can roughly make some guess whether it's a good entry opportunity or whether there's any upside potential.
Right. Okay, cool. Now, this next question is a combination of several questions to ask, several persons will ask the same question. What's your take on First REIT? Is it a buy now?
Just now, I will not buy. Actually, I would like to answer this question, but not in the public because under the Financial Advisor Act, we are not supposed to give this kind of recommendation in the public. So if you need help in your REIT portfolio itself, you can contact me separately, right? So because in order to answer all these kind of questions, I need to understand what is your objective and what is your risk appetite. For example, for some of the investor out there, the risk profile is conservative, right? Then first REIT probably is not suitable, right? But if you're a risk taker, you can make a lot of money from first REIT, but you need to wait for many years. So it's very much depends on the individual investment horizon, risk profile, objective, and every one of you. Because when I recommend the first REIT to my client or recommend them to buy or recommend them to sell, in every individual, I have different recommendation. Some of them I ask them to buy, some of them I ask them to sell. So I don't answer until I really know you in detail on your investment objective.
Okay, cool. All right, great. Thanks for the answer. I'm sorry to disappoint those who asked the question. Kenny couldn't answer the question publicly. But if you really want to find out, then please contact him separately, okay? So I've already posted the links in the chat box, and if you have registered for the webinar, I will also be sending out the replay link to you, and I'll include those links to the various supporters of our webinar today so that you can check them out. Okay, and with that, the time now is 10:30, and we'll call it a wrap for tonight's session. Thank you very much, Kenny. Although there's a little technical hiccup there, but I think we have a very good session with you as well as the other two speakers, Ian Low and Miss Pan Jingy from IG. So, and to all the attendees out here, will stick with us for 2.5 hours. And those of you who are watching us on YouTube Live, thank you very much for your support. And I look forward to seeing you at the next webinar, and have a great week ahead, and I'll see you the next time. Okay, good night and goodbye.